Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. I'm your friend, your mentor, CS Saurabh Jindal from KSJ Teaching, welcoming you all to the start of the new chapter in this session, chapter number 11, that is Instruments of Trade Policy. Now, what is this Instruments of Trade Policy? See, this chapter is not that difficult, very basic things, very easy chapter, but yes, so many tariffs and all these are there. So what you have to do is you have to revise this chapter again and again. Read this chapter from the book again and again so that you are able to remember most of the things, right? So you will need to revise this, read it again and again multiple times. That is how this chapter is to be done, right? So once what I will do is I will explain you all the terminologies, everything that is written here. I will explain you each and everything. Then you will have to read it multiple times so that it fits in your mind that yes, this is how it is to be done, right? So this is important. Okay. So now the trade policy. What is a trade policy? What is trade policy? He says the free trade. One term is the free trade refers to a situation in which the government does not attempt to restrict what its citizens can buy from and sell to another country. So he says one situation is a situation of free trade where the citizens can buy any goods from another country, they can sell any goods from another to another country, right? So all this is in respect of the international trade, that is the exchange of goods and services across the nation. So he says one situation is a free trade, right? That the citizens are absolutely free. There is no government intervention. There is no government restriction of any sort, nothing at all. You are absolutely free to do any kind of trade, buy, sell, whatever you wish to do with the another country. But it poses the practical problems for any economy. He says the government intervention is required anyhow, right? So he says, however, the government intervention in restricting the free flow of goods and services is found in many forms in the practical world. So he says in the practical world, this free trade situation doesn't exist. There will be some sort of government intervention in all the cases, right? Which takes the form of trade barriers, right? So the government intervention here, the name has been given as the trade barriers, that there will be some sort of barriers created by the government so that the people are not absolutely free to buy and sell anything, right? They are not, absolute freedom is not there. See, the absolute freedom will be harmful. If you give absolute freedom to a child, it will be harmful. So some sort of barriers will be set by the parents for their children, isn't it? The same is the situation here. He says if the citizens are given the absolute freedom, then it will be harmful for the economy, for the nation. So some sort of, if not very high, but some sort of government intervention will be required. Clear? So trade policy refers to the instruments and the mechanisms that the government may use to promote or restrict the imports and exports, right? So these are all the tools, all the mechanisms, various ways in which the government can promote or restrict the imports and the exports. So trade policy instruments may be in the form of price related measures, that these are known as tariff, right? Where there is the price involvement, restriction in terms of price. Let's say the parent says, I will not, the child is asking for 1,000 rupees. The parent says, no, I'm not going to give you more than 800 rupees. Where the monetary term is involved, that is known as tariff, right? The second one is the non-price related measures, the non-tariff measures, right? So here the price is not directly involved, but there is some kind of a barrier. For example, the parent says to a child that you won't go out of the house after 6 o'clock, right? So that is a barrier that is created. But is there any price involved in that? No, sir, there is no price. So there is no absolute freedom to the child also. There is no price involved in that also. But at the same time, there is a barrier that is created. So this is what is the non-price related measures, or what we call it as non-tariff measures, where the price is not directly involved, right? So first we'll talk about the tariffs. Tariffs means the price related measures, right? So these are your price related measures. So meaning tariff, also known as the customs duty, is a tax or a duty imposed on goods and services that are imported or exported. So if they say, the government says that if you want to import something or if you want to export something, you will have to pay an extra tax, right? Like if you want to do the business in the local market, in the domestic market, then there is GST. Same ways, they say that if you want to import or export the goods, then you will have to pay the customs duty. Custom duty is what? The tax. Now, how the government controls the import or export? They can increase the tax, they can reduce the tax. Accordingly, they try to control the import and export. Generally, the term is used in the context of imports. Normally, we say when we are importing the goods, at that time we say we have to pay the custom duty on the imports, right? And is identified with the import duties. It is also known as import duty because normally we identify it with the imports and not the exports, so we call it as import duty also. Clear? Okay, so he says, what is the purpose or the impact of tariff? To restrict the trade by increasing the price of imported goods and the services. So say they will increase the tariffs. They will increase the custom duty if they want to make the imported goods costlier, right? If they want to make the earlier, let's say there is a product A. Earlier you were importing that product at 100 rupees and on that you were paying 10 rupees as the custom duty. Now government says, no, no, we want to make this product costlier so that the import is less, right? So what you will do, this product is 100 rupees. The government says now you will have to pay 50 rupees as tax. Earlier it was 110. Now it is 150. So import has become costlier now. So the people will import less. This is done when the government wants people to import less, right? To protect the domestic import competing industries, right? Why it is done? So that you can protect your domestic industries. Otherwise what will happen? The people, if the import is very cheap, people will import the goods from outside and that will be detrimental to the growth of the domestic industry. Now how will the domestic industry flourish? The domestic industry will not be able to flourish if the imports are very, very, very cheap, right? So he says to discourage the consumption of imported foreign goods by making them costly, that if you want to discourage the use of those goods, like we say in the recent times, there has been the things that we should be discouraging the Chinese goods, right? So what was there? Any goods which will be coming from China, they will be having the high customs duty, right? If you are going to go, import the goods from China, you will have to pay high customs duty, right? That is to discourage the imports from that particular place. To decrease the volume of imported goods into the country, that the number of goods which are being imported, that should be decreased. Why, sir? What is another impact of that? Sir, it is directly going to impact your balance of payment, because more you will import, right, more you will have to make the payments, right? And the more you will have to make the payments, it is going to directly impact your balance of payment account. Balance of payment, what is a balance of payment account? That is the export minus the imports, right? Now if your imports are more, your balance of payment account will keep on going negative, right, which is very much detrimental to the growth of any economy. So he says to decrease the volume of imported goods into country, to ensure that the domestic producers of the same product to charge a fair price for such item when compared with the imported item and do not overcharge the consumers, right? So that is why the imports are made costlier, so that the domestic producers can be saved. And if the domestic producers feel that safety, they will charge the fair price, right? If the domestic producers are they do not feel safe with regard to the various policies with regard to the imported goods, right, then what they will do is they will charge high. So if they have the security, they will charge a fair price and not more than that, right? To contribute to the increase in the government revenue in the form of import duties, right, sir? This customs duty is what? It is an indirect tax for the government, right? It is an indirect tax. You must have studied like the GST, and this customs duty is what? This is also an indirect tax. Indirect tax, right? It so goes to the what? It adds to the revenue of government. It adds to what? It adds to the revenue of government. So that is why if the government says that we need to increase the revenue of the central government, the state governments, so they can increase the duties, they can increase the taxes. Simple, right? So this is the purpose or the impact of the tariff. Now, what is the negative impact of tariffs? Can there be negative impacts? Yes, sir, there can be negative impacts, because in some of the cases, the importing goods is quite a good thing, right? Reduction in the consumer well-being due to the higher cost of the imported goods. Now, if you are going to charge high customs duty on the goods which are necessary to be imported, which cannot be manufactured in your own country, which are required to be imported, and if you increase the customs duty or the tariff on those goods, right, it is directly going to affect the ultimate consumer. Why? Because the burden of this increased custom duty will be shifted to whom? Will be shifted to the final consumer. So the final consumer will have to pay the higher tax, will have to pay the higher price, right? So it is directly going to impact the consumer well-being. Clear? After that, he says increase in the prices by the domestic producers of the same item to match with the high cost of imported goods. Again, what will happen if you are importing the goods, and on those imported goods there is high customs duty? The prices of the product will be high, obviously due to the higher taxes. Then domestic producers will say that we will also increase the price. Why we should not be increasing the price, right? So the domestic producers will also increase their prices to match the high cost of imported goods, right? Loss of output and employment in case of sectors that are rendered or redundant due to the import of the goods. Now, there some of the sectors might be dependent upon the import, and if you impose the high customs or the high tariffs on the import, some of these sectors might have to close, right? And the closure will lead to loss of output as well as the loss of employment, right? If the sectors are dependent upon the import of the goods and the import of the good becomes costlier, there are high charges, high tariffs on that, so these segments or these sectors will have to shut down. Then he says creation of trade distortions by encouraging the inefficient production in the home country and discourage the efficient production in the rest of the world. Now, trade distortions we'll study later on also in this part only, right? So it can create the trade distortions by encouraging the inefficient production in the home country. If there are high tariffs on the import, then the home country can take the advantage of that and manufacture more inefficient products can be manufactured. The products which cannot be imported because of the high customs tariff, the domestic industry will try to produce those goods which might not be that efficient as comparison to the other countries same goods, right? So that is there. So these are the negative impacts of the tariff. Sir, these kind of questions can be asked in the examination. Yes, these can be asked in the examination. Clear? Okay. And for your information, guys, the financial management course, a lot of people have been asking me that, sir, please provide the financial management course also in English, in complete English language. It is available on our mobile app and through our website also, which can be played at a very nominal charges around 3,000, 3,500 it is, or 4,000, around in between 3 to 4,000 it is available, right, on our website and on our mobile app also, right, with complete 100% coverage of the ICAI SM. So that is the best combination to cover the concepts, complete English as well as the complete study mat, right? So that is definitely good for you. That is applicable for the upcoming attempts, May 23, November 23, right? So for all these attempts, that is 100% applicable latest lectures. Okay, now he says, what are the major forms of the import tariffs? What are the major forms of the import tariffs, right? So why are we talking only about the imports and not the exports? Because when we try to control the international trade, we are normally trying to control the imports through taxes, right? Because every country wants to encourage exports. What is the main purpose of every country? Every country says we need to encourage what? We need to encourage our exports, right? And we need to discourage. We need to discourage means we need to reduce what? We need to reduce our imports, right? So if you want to encourage something, if you want to increase something, that is you want to increase your exports, what will you do, sir? In that case, you will provide the subsidies on exports, right? And when you want to discourage the imports, what will you do? You will put the tariffs or taxes. That is why when we are talking about these tariff or the taxes, the main part is in relation to the import and not the export, right? So this can be the question that might come to your mind, that why, sir, it is being related more to the import and not to the export, right? Okay, what are the two major forms of import tariffs? That there are two major forms. One is the specific tariff. Now, what is a specific tariff? It says the fixed monetary tax per physical unit of the good imported. So, if you are importing the good, right, and on the basis of what is the weight, what is the volume of that good, right, a fixed rate will be calculated. He says it is calculated on the basis of a unit of measure like the weight, volume. It is not calculated on the price, right? It is being calculated on the basis of the weight of that product which is being imported, or the volume, how many number of units you are importing, right? On that basis there will be a rate. For example, the specific tariff of rupees 1000 on each unit of the imported bicycle, right? So it talks about, when we are talking about on each unit, that means we are putting it on the basis of volume, right? So that means if you import 100 units, what will be the tariff? The tariff will be 1000 into 100, that is 1 lakh rupees. Simple. If you import 50 units, what will be the tariff? That is 1000 into 50, 50,000 rupees, right? The specific tariff says the tariff is being imposed on the basis of the volume, that is the number of units that you are importing, or on the basis of the weight also. For example, 1000 rupees, we can say the 1000 rupees per 100 kg, right? So if it is the material that you are importing, or the product that you are importing is 100 kg, you will have to pay 1000 rupees. If it is 200 kg, you will have to pay 2000 rupees. Clear? So this is how it is being done, on the basis of weight or the volume. The disadvantage of the specific tariff is that its protective value varies inversely with the price of the import. What does it mean, sir? What does it mean? This is important. The disadvantage of the specific tariff is that the protective value varies inversely with the price of the import. Now, try to understand what is meant by this. He says when you are talking about the specific tariff, when you are talking about the specific tariff is being imposed on the basis of unit or on the basis of volume. Unit, I'll say weight here, let's say. On the basis of weight or on the basis of volume, right? Let's say the tariff says it is 1000 rupees, right, for one bicycle that is imported. 1000 rupees for one bicycle that is imported. The price of this bicycle is, let's say, rupees 10,000, right? Now, is there any relation of this 1000 with the 10,000? No, sir. Right? Now what happens? After a few months, they say this 1000 rupees, again 1000 rupees for one bicycle, but the price has increased to 15,000 rupees. Now, can you increase the tariff? Can you increase this specific tariff? No, sir. It will remain 1000 only, because the number of units imported are the same, whereas the value has increased. That is why it says the protective value varies inversely with the value of the product. The specific tariff is that its protective value means the value of the tariff varies inversely with the price of the import. Now, if the price of the import is increasing, right, by 5,000, this might increase by 1100 over a period as per the policy, but it has nothing to do with the price. The price increases. If the price increases, this is not going to increase. That is why it is inversely related, the specific tariff, right? These small things are very important to understand in such cases. Clear? Okay, after that we have the ad valorem tariff. What is ad valorem tariff? It is levied as a constant percentage of the monetary value of one unit of the imported good. Now he says The specific tariff is not on the value, but the ad valorem tariff. Ad valorem tariff is on as a percentage of the monetary value. Let's say here the bicycle is for 10,000 rupees. The government says we'll charge at the rate of 10%. Right, so it will be 1,000 rupees. Now if this value increases to 15,000, still you are charging the duty at the rate of 10%. Your tariff will also increase to 1,500. So your tariff has increased here by 500 rupees with the increase in the value. So the problem with the specific tariff is resolved here if you have the value. A 20% ad valorem tariff on the value of each unit of the bicycle imported. So if the price of bicycle is 5,000 rupees, the ad valorem tariff will be 1,000, that is 20% of 5,000. If the price of bicycle increases to 10,000, the ad valorem tariff will also increase to 2,000 rupees, that is 20% of 10,000. Ad valorem tariff preserves the protective value of the tariff on home products. It gives benefit of more revenue during the inflation. Because during the inflation, what will happen, sir? During the inflation, the prices of the products will be high, and if the prices of the products are high, this ad valorem tariff will also be high, because it is being calculated on the value of the product and not on the weight or volume. However, it also gives the incentives to deliberately undervalue the price of imported goods to avoid tax. Yes, when you are doing it on the basis of value, what the people can do is they can undervalue, they can deliberately go into the things that they will undervalue their products. On the invoice, they will undervalue the products, right? They will say, no, it is not 10,000, it is being valued at 8,000 only. Why? To prevent this higher taxes, the ad valorem taxes, right? So sir, there is a question that what was the need for these two, how these two can be used under the different circumstances, that if ad valorem tariff was there, why is the need for the specific tariff, sir? Right? Why the specific, if there was specific tariff, why was the need for the ad valorem tariff? So if the product, just try to understand, if the product that you are importing, right, is does not have too much of the price fluctuations, if you analyze over the periods, that if that product is being imported multiple times into the country and the prices almost remain the same, right, what is changing is the number of units or the volume of the imports, then there the specific tariff will be applicable, will be more helpful, right? If there are no price fluctuations, try to understand. Let's say there is a particular product A, right, and there are no price fluctuations, right, that the prices remain more or less the same, right? So what is the changing? The volume of imports is changing, volume of import changes, right? So which of these tariff will be helpful in this situation? Your specific tariff will be, right, this one specific tariff will be applicable. Now there is a product B with high price fluctuation, then what will happen, sir? If there is a product B with high price fluctuation, irrespective of whatever is the volume being imported, right? If there is a high price fluctuation, in that case, it is better to apply the ad valorem tariff. Ad valorem tariff. Right? So this is the difference between these two, that why under what circumstances the specific tariff can be helpful and under what circumstances the ad valorem tariff will be helpful, right? So I have explained it to you in a very simple way that these are broadly the two types of tariffs, right? After that we have the other forms of tariff. What can be the other forms of tariff? Like we will cover one, two. Right, after that, because the other forms will take some time, we'll do it in the next lecture. I'll just cover one or two which are specifically related to this specific and ad valorem. They say mixed tariff. What is a mixed tariff? Mixed tariff is expressed as either specific tariff or ad valorem tariff, depending upon which generates the most income for the nation, right? So we will choose depending upon what is beneficial for the nation. right? Which of the tariffs will generate more revenue for the nation, we will select that. But either of the one should will be applicable, either specific or ad valorem, right? So he says duty on cotton 5% ad valorem or 3000 per ton, whichever is higher. If you are importing high volumes and the rate is not that much, the value is not that high, but the volume is high, in that case, this specific tariff will be applicable. But if the volume is less, but the price is high, in that case, the ad valorem will be applicable, right? So mixed tariff says we will apply either of this, either the specific tariff or the ad valorem, whichever generates the most income for the nation, right? Depending upon either the value or the volume. If volume is high, the specific tariff is beneficial. If the value is high, then the ad valorem tariff is beneficial. Then we have the compound tariff. Compound tariff is a combination of ad valorem tariff and the specific tariff. So compound tariff says we are going to combine these two. Now it is not either this or this. We are going to combine, we are going to use both these. It is calculated on the basis of both the value of the imported goods and a unit of measure of the imported goods. So it is being calculated on the value also and on the unit of weight or volume also. For example, duty on cheese, 5% ad valorem, 5% on the value plus 100 rupees per kg. That is compound tariff. Compound is you are combining both the things, right? In the mixed tariff, it was either specific or ad valorem. In case of compound, it is both ad valorem plus specific tariff, right? So next we have is technical or other tariff. Technical or other tariff. It is calculated on the basis of specific contents of the imported goods. He say, let's say you are importing the solar panel. Now in that, what will be there? The solar panel will be there along with the batteries, right? But he says we are going to calculate the tariff on the individual components. On the panel there will be 3000 rupees and on the battery there will be 50 per kg, right? Both are, one is on the basis of the volume, another one is on the basis of the weight. So we are going to charge the tariff on the basis of the individual contents of whatever the goods you are importing. Let's say there is a toy bike. There is a toy bike that is being imported, right? So he says this toy bike is battery operated. It is battery operated. They will say that on this bike, on the number of units that you are importing, will charge 3000 as the tariff. Both of this, it is specific tariff only. And on the batteries, we will charge it on the basis of the weight, that what is the weight of this battery, 50 rupees per kg. Whatever is the weight of the battery, on that you will pay the tariff, right? Then you have the tariff rate quotas. What is tariff rate quota? It is a combination of two policy instruments. One is the quotas and the tariff. Quotas means that you have the specific limits that is set. If the import is below the quota limit, right, you have set the limit that this much, if you are going to import this much quantity only, then there will be no or low tariff, right? Let's say if you say for a particular product, if you import less than 1000 units in a year, right, then the tariff will be, let's say 500 rupees per unit. But this is what? This is your quota now, right? And they say if you import more than 1000 units in a year, the price will be, the tariff will be 1000 units per unit. This is what is known as tariff rate quotas. The quotas are set, the limits are set, and if it is below the limit, then no or low tariff. If the import exceeds the quota limit, then the much higher tariff will be charged. This is why this is done. This is to discourage the high volumes of the import, right? So that there is no high volume of import. Otherwise, what will happen, sir? The domestic industry will be hit badly, right? So it is the most favored nation. Most favored nation will do later on, right? Most favored nation will continue it in the next lecture, because the next tariffs are little bit related. The most favored nation, then variable, then preferential tariff, then bound tariff, applied tariff, escalated, prohibitive tariff, import subsidies, tariff as a response to trade distortions. So all these things, and what are the effects of the import tariffs, all these things we are going to continue it in the next lecture. We'll try to understand, very simple, but little bit confusing. So you need to concentrate with the small variations. All these tariffs are there with little bit of variation in each of the tariff, right? So that can create the confusions, but we will try to understand that what is the difference between all these tariff, right? So we'll try to cover this the tariff part in the next lecture, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.